Let's first talk about how commercial real estate is valued. So this is a value, this is where the cap rate comes in play. The cap rate is short for the capitalization rate. And in short, the capitalization rate is a multiplier of income to determine the value. So commercial real estate is valued based on its income. The more income the box produces, the more the box is worth. So if you have one box worth $1 million, it could be there's a box just like it next door, but it's valued at $1.5 million. Why? What's the difference? Well, the one on the right, $1.5 million, is producing more income than the box on the left, which is valued at $1 million. So our strategy is to look for boxes on the left that are valued for $1 million, fix them up and make them produce the income like the box on the right, and now we can sell the box for a profit, or better yet, we can do a cash out refinance at the $1.5 million valuation, return the principal back to investors. They continue receiving checks for free. They have no more money in there, and we just keep doing it over and over again. So that's really the idea behind how commercial real estate is valued. And at the heart of that is this cap rate, it's this multiplier, right? So sometimes the multiplier is higher and sometimes it's lower. For example, imagine you had an ATM machine, okay, and it's in the Whole Foods right near your house, and it's this beautiful mixed use. There's bars, restaurants, that kind of stuff. So the owner of that ATM might be willing to put up with a lower return because it's not going to get vandalized. People are going to use it more often, right? So the owner of that one says, I'm happy with a 7% return on that box that I put in place, and maybe it cost me $50,000 to do that. On the other hand, the same ATM machine in the ghetto, the owner of that ATM, the returns for that one have to be much, much higher. Okay, so that person is going to be willing to spend a lot less for that box so that the returns are higher, because he has to deal with vandalism and theft and that kind of stuff. So his returns have to be higher to make up for the location it's in. And a cap rate is the same thing. It's just an inverse relationship. The formula is value or price equals to the net operating income, or the income divided by cap rate. So in other words, the lower the cap, it's an inverse rate. The lower the cap rate, the higher the price. Similarly, the higher the cap rate, the lower the price. So if you see a cap rate of 5%, that means that the investor of whatever investment that 5% cap rate applies to is willing to put up with a lower return, and because it's an inverse relationship to income, the lower the cap rate, the higher the price. They're willing to pay more for an asset, probably because it's in a much better area. Could be a Class A apartment building, could be Class A office space. On the other hand, if you're in the middle of nowhere, okay, and maybe it's a rougher area, maybe it's a Class D property, then the owner of that is going to look for a higher return, which means they're willing to pay lower for that, so the cap rate is going to be higher. All right? So don't get overwhelmed with all the math, but this is the basic formula. This is what's used all over commercial real estate to value commercial property. All right? So that makes sense. So the example here is, if I have a net operating income is everything is income minus expenses. Okay, but before debt service, before paying the mortgage, that's the NOI. So it's the actual net income before paying the debt on it. So let's say that the NOI, net operating income, is $202,000, and the cap rate is 8%. Now the cap rate is determined by the market, and so this varies from asset type to asset class and geography. But normally the broker or the appraiser will know what the cap rate is, because they know what has sold that is similar in style. So let's say the cap rate is 8%. So if I divide 202,000 divided by 8, that's a valuation of $2.5 million. So that's how brokers and appraisers value commercial real estate. Look at the NOI, they divide it by the prevailing cap rate, and they get their value. All right, makes sense? So that is how we value any commercial real estate.